Liz, do you agree with Barb that this has provided a buying opportunity, especially from some of the beaten down growth names? NASDAQ going out with a loss for the month of 3.4%.
I would still be waiting in those growth names until after we get past the first hike. It's been seen before, if you look historically, when a hiking cycle begins, you don't see a firming up in technology in some of those higher growth names until after the hikes start. So I would still wait that out a little bit longer, and then I'd be really choosy about it. You have to choose high quality growth, and you have to choose growth that has earnings momentum behind it. Earnings are going to slow this year. The growth rates are going to slow. GDP growth is going to slow compared to last year. That doesn't make it bad. That doesn't make it weak. It's just a different part of the business cycle. So the market is going to have to really search for opportunities and find things that are durable through this part of the cycle. And I think that we're still up against quite a few headwinds here in the first half. As we mentioned, inflation's still an issue. I don't think that this crisis helps that issue at all. I think the Fed still has to act, and all this has really done was take the expectation of possibly 50 basis points back down to 25 basis points. But regardless, we're still in a hiking cycle. We still have headwinds for growth stocks until we get some of that beginning out of the way.
Liz, the idea of migrating toward quality stocks, companies with these defensible high profit margins and good balance sheets, it makes a lot of sense. That's what happens in mid-cycles. They tend to do better. But how do you distinguish that from the big NASDAQ 100 names? Because pretty much FANG, aside from, let's say, Amazon and Netflix, they're quality. I mean, they're all high in the quality factor indexes and ETFs.
Yeah, and I would define those as companies that do have that good competitive moat, and they have pricing power, right? We've seen price rises because of inflation. You want to have companies that have that pricing power, can raise their prices and not lose customers in the meantime. So a lot of those big FANG names during the pandemic have become blue chip stocks, and they're going to continue to act that way, especially in times of fear when investors still see more opportunity in equities than in other asset classes. And I do think even after a rally in bonds today, I think that we'll see that relax. We'll see the 10-year yield get back up closer to 2% again, and some of this will normalize as far as yields go. And you'll still see resilience in those big tech stocks. And then underneath the surface of those tech stocks is where I think the quality piece matters. I would look at cash flow, too, because as rates rise, you want companies that can internally finance their growth and don't have to rely on rising rates to do so.